Thanks, Andy, and good morning, everyone. I make very few decisions. There's actually lots of people in my team, but yeah, it's on me. Westpac, like the NAB, like the ANZ, like the CBA in Australia, are now very large organisations. And from Westpac's perspective, we give grants to people, to institutions, to organisations, to ideas through the Westpac Foundation. We do a little bit of equity, not much, and we do a fair bit of debt through either just straight financing or through the capital markets. What I wanted to talk to you about this morning was on the debt and capital market side. Not to go into a great deal of detail, but just in the few minutes to give some introductory remarks, but some of those overarching principles that apply. One of the things, though, that I would point out initially is that there's 40,000 people in Westpac, and I would say that the vast majority of them are intuitively aligned with what all of you in the room are trying to achieve. So when you are borrowing money, or you're talking to us about a capital markets investment, or you're looking at equity, or you're looking at a grant, there's a whole heap of intellectual capital in the room that Westpac people, and I'm sure the other banks are the same, would love to share with you. So first point, never be afraid to ask, because the generosity of spirit, you may not think it from bankers, but I guarantee if you ask, you'll be inundated with at least an opinion, because bankers always have an opinion. What I am talking about, though, is lending of one sort or another, and let's just keep it in that umbrella, whether it ends up through capital markets or lending, it's debt into an organisation. So bottom line, we're a bank, we lend you money, we expect to get it back. And we also expect to get it back with a return. And that permeates most of what a bank does and the conversations that we'll have with you. So if we lend you money and we want it back, then there are some rules, principles, guidelines that we apply. And it's probably not surprising that there are a number of things that are the same, whether we're lending to a social enterprise, a social venture, an individual, a corporate or an institution. There are some rules that are the same, and there are some rules that are different. So what's the same? Well, some of the things that are the same, whenever we lend money, one of the first things we do is we look to the sponsor, the individuals that are proposing the scheme or the idea, and we look for your experience, your expertise, your credibility, your track record. It's a very significant factor. So every time you talk to your bank, the same way as every time you talk to an investor or a grant provider, you're being interviewed. You're being interviewed for your expertise, your credibility, your soundness. Like any lending, we look at the business model that you've got and whether your ratios stack up. And we're not going to lend you money unless there is some way to pay it back. So we look for the cash flow and we look for the usual ratios. And obviously the ratios will get more complex, the bigger the lend, the bigger the organisation. But at the end of the day, we look to the financial ratios whenever we lend money. We look at things like diversification benefits. Is this an enterprise which has one idea, and if the idea fails, the whole enterprise fails? Or is this one of a whole suite of opportunities where, frankly, you can afford for one or two of them to fail and it doesn't collapse the whole organisation? Diversification is one of the great risk management tools. And finally, we'll look at, depending on the nature of the organisation, but if you borrow some money, get some equity, get a grant, and you use it all on setting up the organisation, how are you going to run it? Are you being realistic about your CapEx and your maintenance needs over time so that you can support the business both in its introductory stages and also as it grows and hopefully thrives? So there's some of the commonalities. We'll apply that to any type of lending or capital markets activity. But there are, for you in this room with social ventures and the like, some important differences. Westpac has quite a bit of experience these days in lending into social and affordable housing. We've just done a social benefit bond. That's our primary area of expertise at the moment. I'm happy to talk about that in the Q&A or later. I don't want to go into any detail about that, but that does indicate that we have got some track record at this stuff. And again, we will talk to you about the individual characteristics of each investment. Very important and different. Every transaction is different. We will spend the initial time, we'll then do the due diligence, we'll keep talking. It is, though, nevertheless, quite an untested model in Australia, so we're all learning. And that's a good thing and a bad thing. Precedent helps you know where you can take a risk, but not having the precedent allows you to generate the discussions. So again, going back to my initial point, keep the conversation going. Significantly though, and this goes to the redress point that Sandy mentioned before, when you do normal lending to an individual or a corporate or an institution, we generally like to have a second way out and a third way out. So the first way out is that the cash flow from the business will repay the debt. The second way is often some form of security, whether that's a house or some industrial property or intellectual property or the like. The third way out is we will take guarantees. You very rarely get a second or a third way out in this type of investing. So if there's no second or third way out, the natural reaction is we will lend you less money. It is an inevitable consequence. So whereas in an individual housing loan, for example, we might lend you 80%, 85%, sometimes even 90% of the value of the property, in an affordable housing context, we struggle to get past 20%. Because you need to have the cash flows being able to support the lending and those cash flows to amortise the debt over quite a lengthy period of time. Because frankly, an organisation like Westpac will not go in and sell up Mission Australia's portfolio of housing. We simply would not do it. So while we'll take all of the security, it is highly unlikely, at least while I'm in the chair and my boss is in the chair and Gail's in the chair, I think it's highly unlikely that we would go in and sell up under all of the people that Mission Australia is supporting, as well as all of the other community housing providers. Finally, you need to look at, if you do go in and enforce, well, you'll often go in and enforce which will make the not-for-profit fail. And that's really not a good look either. And when we look at investing in this or lending into this environment, credit risk is usually first and foremost. We have $700 billion of assets. We want $700 billion left. So credit risk is our biggest risk, but it's also the one that's relatively straightforward to manage because we've got a long history. Lending into this space, we're very conscious of reputation risk. It doesn't matter whether we've got every legal right in the world, we will not sell up that property and put people on the street. We don't generally do it in, in paying sectors. We're not going to do it in this sector. We look at liquidity, we look at enforceability of security, as I said, we look at regulatory and political intervention, and we look at refinance risk. If we give a three-year facility in this sector, if the investment is not performing that well, it's unlikely that anyone else will come in and take it off our hands. So even when we're looking at a 3-year facility, we actually look at it to the death. We either get repaid or we lose our money. And whether that's over a 3, 5, 7 or 10-year period. The final couple of points that I just wanted to make is more general. So whether you're borrowing now or intending to borrow later or to apply for a grant or to seek equity from investors, there's some things you should be doing in your own, on your own side of the fence which will help when that time comes. You really need to get your board in order. I've been told many times that it's much, much easier to get a board member onto a board than to get them off. in a not-for-profit. So you need to be really ruthless about who's on your board and what skills they bring. You need to have succession planning worked out. You need to have good financial literacy on your board. It doesn't have to be everyone, but you need at least 2. You should be thinking about governance. What are the policies, the frameworks, the protocols you've got in place? It's much easier to put those in place when you're this big than when you're this big. And finally, be realistic. Doreen last night was giving a presentation and she said she has all of these entrepreneurs come to her and say, based on Silicon Valley standards, my business is worth 30 million bucks. Well, maybe it is, but to a banker, it ain't worth nothing if there's no cash flow. So you actually need to be really realistic about what your business is and what it can deliver, and hopefully it will grow to be successful. But if you're unrealistic, then that'll be one of the examples of why an investor will talk to you and then won't invest. So all of those hygiene things at the outset will really make it much easier for you and give you a much greater chance of success when the time comes for you to generate that those investments or lending to help make your business grow and prosper. Thank you.
Okay, I want to start, I guess, in the theme of the panel in risk, and then move to redress. I think essentially risk-taking in this space kind of boils down to a yes or a no. I mean, really, if we make it very simple. And for us in the work that we're doing day to day with social enterprises, that process of saying yes or no starts in the due diligence process. So relationship building, understanding the social enterprise and its objectives, getting to know them across a range of criteria, and starting to form an opinion about whether you can say yes, therefore take a risk, or say no, therefore avoid a risk. I think that some of the challenges around risk-taking go to some of the comments we were talking about in the CEDAF panel yesterday, and that for an organisation like Foresters or CIFA or SVA, managing the funds we manage is actually in the first instance about trying to take risks that other financial institutions aren't prepared to take. And in terms of the conversation around risk-taking, really we tend to look at it in a technical sense and say, well, these are all of the things that we've got to do to manage that risk, make sure that things don't go pear-shaped on us. That's all really important, but we also need to be in a conversation around what we're prepared to do, how much risk we're prepared to take. So for our business development lending, for example, some of the conversations that we have around risk and risk management go to, you know, what are we prepared to do? Are we prepared, in fact, to take this cash flow forecast that this very passionate entrepreneur has put in front of us and believe it? And if we are to believe it, on what basis do we believe it? And I can tell you right now that in a lot of what we're doing, the basis for believability is firmly centred on the individual. We can't kind of judge what the future of some of these enterprises will be about, and certainly some numbers on a page aren't going to give us any kinds of guarantees, but nonetheless that's the information that we have to work with. So we often find ourselves sitting having conversations about believability, about whether the people in the enterprise are skilled and capable and focused, and whether the passion they have for their social cause or mission is actually executable, whether the skills are there to actually execute. Calibrating risk as well to the needs of the market is another challenge in this work. And I think we're seeing it play out in the marketplace. You can see it play out in the investor handbook. Again, there are a whole range of social entrepreneurs and enterprises with absolutely incredible ideas that, if we're all honest, actually we'd like to see a lot of them realised. But whether finance is the way to do that, whether taking a loan at their stage of development is the way to do that, is a really critical question to ask. So again, we see a lot of enterprises walk through our door who need money, but do they need the kind of money that we have is another question. Which leads me to my kind of final point on risk, which is the bit about saying no. Probably the hardest bit, and we were talking earlier before the panel started, and Sandy talked about the process today of investors actually going around to the table and giving honest feedback about why not. And I think that's critical, and it's not just critical because as investors, it's our right to do. It's critical for a developmental reason. If you don't get good feedback, if you don't understand why an investor or a lender has decided not to lend to you, then you cannot go away and change any of that behaviour or approach, or make changes to the business model that would allow you to come back through the door again. So in our work, we've spent a lot of time, and we've still got a way to go, articulating why we say no, what risks we've perceived that we're not prepared to back, what the things are in the business model that we think are exceptional and good, and all of the things that we suggest enterprises should do to go away and make that better so they can come back through our door again. Because ultimately, in our organisation, it is in the end about the development of the social enterprise market. So it's not no forever, it's just no, not now. They're not easy conversations, and indeed, many of the conversations that we've had are extremely difficult, some of them quite emotional. I can see Libby nodding her head down there. Hard to have, but really critical. Then to the issue of redress, and really I think what we mean packed up in that nice word is, as we've just talked about, if it all goes wrong, how do we get the money back? And I think this is really challenging, an area that we have to spend some more time thinking hard about, particularly in the social enterprise space, and particularly for those loans that we're making that are unsecured business development loans. Our funds are too young yet to really know what the fallover rate is going to look like in them. So 18 months into them, we have a portfolio of loans, and at this point in time I can tell you that they're all tracking along as we would expect them to. But as I said, they're young, so in another 2 years, in another 3 years, some of those loans may actually fall over. So what would we do? Well, we would go back to the original relationship, go back to the due diligence that we did, and look to whether we could reshape that loan to bring it back online, get it back on track, look at where the enterprise is at and try and match the loan as it stands today with the changed circumstances of that social enterprise, and really try to aim for some sort of successful outcome. But I think, the reality will be that although we might use all our best endeavours to get to that outcome, there will be some loans in our funds that we'll have to write off, that will be lost capital to us. And again, I come back to my opening statement. Really, it's going to be about whether we've made the right decision, whether we've said yes to the right things and no to the things that just aren't going to work. And we're not always going to get that right. We are going to have to expect that things are going to go wrong. And because we're also familiar with grant making and receiving grants, it's actually hard to get any transparency often on what goes wrong in grant making. We will see things go wrong, and they will be not so good stories. But if we're brave enough to actually engage in social finance and social investment, then we're going to have to expect that those failures may come. They may be uncomfortable, but it is just part of the territory. Thanks.
Risk, the potential of loss. Anybody out there like loss? Lost? No, loss. Lost is even worse. We've had lots of conversation over this conference about the measurement of social impact. Measuring risk is, I think, just as difficult. I'd love to think we had a really easy measure of risk so that when an investment came to my table, I could just go, it's either above the line or below the line, and we can make a really easy decision. But as a number of you entrepreneurs have actually found out over the last day or so, and probably well before that, when an investor comes to you, you actually have a great potential of losing the investor at the very moment they can't assess the risk and work out where your business is actually at. My trustees have a term called light us up. And that's the first introduction point around being able to get past that risk factor. Tell us about your business in a way that gets us excited about it. But that excitement quickly changes the moment we get to trying to assess the risk of the investment. There's a great quote from Will Smith has in a movie called, and I've just had a mental blank of the movie name, which is terrible. No, his more recent one, On Earth. Somebody give me the name. Sorry? No. Oh dear. Anyway, I'll give you the quote and we'll work out which movie it's from later. Yes. Yes. Fear is not real. It is a product of the thoughts you create. Now, don't misunderstand me. Danger is very real, but fear is a choice. When we assess risk, we actually assess it from those two perspectives of both fear and danger of that loss. So when you come and you present your business as an investment, we have to first assess what is the fear of risk here. And the best way that you can lower that risk for me is to be able to explain your business model well, show your thinking, and show the financials that the business model produces in order to help me understand that you understand your fear. Remember, fear is just a cognitive thing. It may happen, it may not, and it's constructed in your mind. And therefore, using cognitive processes, you can write the business model, produce the financials, write the business plan, and convince me that you understand the fear of risk. And this is a great way of interacting. And so when somebody comes to your stand today, entrepreneurs, and talks to you, make sure you are really able to articulate the fear of loss, that risk, in a way where you can explain the business model and the financials, because that is one of the first things that we need to take care of. The thing that very quickly follows that, though, is you, the entrepreneur, or the people involved in the organisation. And that's where we get to deal with danger. Danger is fear realised. It's the actual risk starting to take place in the business. And that's a much more difficult thing to manage and to predict. So when we make an investment, we do the assessment first based on all of our fears, the joint fears of the business owner, the investment owner, and bringing those together in a way that we have a good plan to manage that. But really, the only way you manage it is with people. People are the ones who actually manage and respond to risk. And when risk becomes real danger, not just a fear, we have to be able to respond. So one of the key things we assess, of course, is the people. And there's really two kinds of people that we're looking for. The first one is the entrepreneur who knows how to think and to be able to plan for those fears of risk, but also be able to execute and be agile when real danger appears and be able to respond to it. We also put in place governance structures, which you're all familiar with, and we've heard about boards. And I think they're the additional mechanism to make sure that when fear becomes danger, we can actually respond to the risks that are there. So our process for managing risk from an investor's point of view is first assess the cognitive construct, the business model. Second, assess the person. And third, put in place the ability to manage redress. And what should happen in this sector, even more than any other sector, is that we should have no surprises. That if we've put in place that redress process around real danger, of governance and the right people, we should be able to continually respond to slight changes that says we're heading in the wrong direction, that there's a danger actually emerging. And if we have the right levels of governance from boards and entrepreneurs, we should be able to respond so we don't actually have any surprises. Now, that's not to say investments won't go bad, but it does say that we can respond appropriately to them, close them down slowly, not take back assets that are going to hurt people that we don't want to hurt. But it is about a planning process that allows us to ensure the governance is there and manage the realisation of risk. So redress becomes a process, not a point in time. It's not at the point of failure that we should be intersecting and actually worrying about redress. It should be all the way along in the business. That as real fears become dangers and that risk realised, that we can respond appropriately and agilely to it. We can't afford the kind of failures that the commercial sector can afford, because our beneficiaries and the people who benefit most from the work that we do can't afford that kind of impact. So I want to encourage us that we need to not only really engage risk cognitively and with a governance process, but we really need to engage it on behalf of the people that we serve as a protection measure. It's actually one of the reasons I'm firmly a believer that actually social enterprise can deliver above market rates of return on average over the long period of time, because we care more deeply about keeping our businesses going than anybody else on the planet. Because it's not just about money, but it's actually about people's lives and making a really positive difference in the world. That's what gives me hope and some optimism, that even though risk is real and hard to measure, and the redress process is tough, this sector has a bright future because we can actually address both of those things.